Mortgage rates are rising, and inflation shows no signs of abating, both of which affect the housing market. House sales this year will be the lowest since 2011. Constant costs are probable due to high pricing and slow construction rates. It will prevent a flood of foreclosures. After a year of steadily rising inflation and interest rates, the housing market has become very unstable. A year ago, mortgage rates were at historic lows, and house prices rose rapidly. There are now close to 7% mortgage rates, and property values have increased by over 40% since March 2022. The housing market took a major hit due to the last health crisis, when the economy suddenly slowed dramatically and millions of people lost their jobs. The government took unprecedented action. Almost every John, Sally, and Mary received a payment. Debt became essentially free to take on as interest rates plummeted. The mortgage rate market reached a record low of 2.65% in January 2021. Then everyone relocated to brand new neighborhoods. Due to advancements in technology that allowed for telecommuting or a shift in priorities, many people uprooted their lives and relocated to other areas. The low cost of mortgages helped fuel a property market boom. Normal folks couldn't afford to purchase in one of the hottest markets in years because prices shot through the roof. High inflation resulted from several factors, including increased cost of living, difficulties finding work, and breakdowns in the supply system. According to several experts, the highest annual price increase over the next 3 years will be 9.1%. The Federal Reserve hiked interest rates to calm the unstable markets. This increased the cost of borrowing money, which in turn reduced consumer spending. Mortgage rates have increased in tandem with the Federal Reserve's target interest rate, which is presently close to 4%. It's often assumed that a combination of high prices and high interest rates indicates a severe downturn in the housing market. Some housing market segments are slowing, although any shifts might be gradual. Variations in mortgage interest rates have consequences. Mortgage rates are now higher than they were a year ago due to the increase in the federal funds rate. Before the Federal Reserve's rate rises even took effect, in certain situations. At its high point in early December, the average 30-year mortgage rate was close to 6.5%, more than twice the average rate in January 2021. However, it has been over 15 years since average rates were greater than 15%, which are still far lower than the 18% seen in the 1980s. The ramifications of such sky-high interest rates are staggering, even if property values remain unchanged. Consider a loan of $300,000 at a fixed interest rate for 30 years before deducting taxes and other fees. When you include the 6.5% interest rate, your monthly payment is less than $1,900. Over the course of 30 years, your total cost will be close to $683,000. Simply put, the interest you pay on a loan will exceed the house's original value. On the other hand, if the interest rate is 3%, your monthly payment will be close to $1,265 or a little more than $455,330 after 30 years. Thanks to today's low rates, you may buy twice as much house for the same amount of interest. Home prices and a persistent shortage are at the root of the problem. Most of the time, when loan rates rise, property values fall to compensate. However, in 2022, this has not been the case. One of the primary causes is the law of supply and demand. The United States already lacked enough housing supplies before the epidemic hit. By 2021, there will be a significant demand for between 5.5 and 6.8 million new houses, according to the National Association of Realtors. Home prices might remain elevated for this reason. Supply constraints will likely prevent prices from falling too much, even if fewer people are able to afford purchases. Mass foreclosures are still unlikely due to the improved job market and the reduced difficulty of obtaining aid compared to the time of the 2008 financial crisis. However, this doesn't rule out the possibility that housing prices have already begun to fall. According to the S&P Case-Shiller Index, the value of a house rose 7.8% between September 2021 and September 2022. Nonetheless, costs were reduced by 2.6% from June to September, indicating that relief is on the way. Drops like this were particularly pronounced in urban areas, where housing values had already begun to fall. San Francisco and Seattle both had decreases of 10% over 3 months, while Denver and Los Angeles saw decreases of roughly 5.6%. A decline in mortgage and real estate transactions is being seen. In spite of persistently high mortgage rates and house prices, the building has slowed. In October, the annual rate of new housing starts fell by 8.8%, while the annual rate of new building permits submitted fell by 10%. Property sales, both new and resale, have begun to decline. According to the National Association of Realtors, contracts to purchase previously owned houses fell 4.6% in October. Sales have fallen for 5 consecutive months. The sale of previously constructed houses dropped by 32% between January and October 2022. Overall, loan application volume is down by more than 41%, while refinancing application volume is down by over 90%. U.S. housing market chief economist Mark Zandi describes the situation as disappearing. Paul Ashworth, head economist at Capital Economics, concurs. It has been totally devastating the U.S. housing market. Despite this, many experts see something else in 2023. There may be some signs of weakening in the housing market, although yearly price declines have not yet occurred. However, housing market analysts predict this will continue for a while. For instance, the investment bank Morgan Stanley predicts a 10% decline in the median house price between June 2022 and January 2024. That may seem like a lot, but it pales compared to the 40% increase in market prices since the beginning of 2020. That is to say, the analysts at Morgan Stanley aren't bracing for a fall. Instead, they are bracing for a little correction that will bring an inflated market back down to earth. Many are predicting several trends for the sector in the year 2023. The most critical fact to remember is that the slowdown in the U.S. housing market has already begun and will continue for at least another year. We expect home sales to drop to their lowest level in 10 years. Redfin's first major forecast is that house sales will decrease by around 16% in 2023 to about 4.3 million. New construction prices are also predicted to fall by 20%. If this trend continues, house sales in 2023 will fall to their lowest level since 2011, with only 32% of all available dwellings selling. The brokerage statistics show that individuals will remain put for the time being due to high mortgage rates, rising inflation, and the prospect of a recession. If inflation remains higher or for a longer period of time than anticipated, many predict a 27% reduction in sales. While the pace of foreclosures may cause some concern, the high equity of most homes and the robust employment market should calm most people's fears. With this, mortgage rates will also decrease. By the end of 2023, 30-year fixed mortgage rates will have decreased to roughly 5.8% from their current levels. The typical homeowner of a $400,000 house might save $150 each month because of this reduction. To what extent expenditure and GDP growth, or reduction, in the future year affect the pace at which inflation and interest rates fall is unclear. Inflationary pressures will lead to falling home prices. In 2023, the typical sale price of a house in the United States will fall by around 4%, landing at $368,000 on average. Even though housing would still be less affordable than before the crisis because of high borrowing rates and prices growing faster than income growth, this would be the first-year reduction since 2012. Prices might fall even more if the housing shortage wasn't so severe. However, the business anticipates a slowdown in APOS through most of 2023, limiting supply and driving up prices. In addition, rentals will also decrease. Rental rates throughout the United States will fall. High loan rates will make homeowners less inclined to purchase and sell single-family houses, which might imply that single-family rentals will become more popular. Also, apartment construction is at a 50-year high. So, in 2023, the rental market will be flooded with tens of thousands of brand-new apartments. This increasing trend is expected to continue as builders realize that creating multifamily homes makes more financial sense than building single-family units. The housing market in the United States is slowing down. The American ideal has traditionally included the purchase of one's own house. Most contemporary families, however, need to achieve this goal because of inflation and high interest rates. But the housing market of today damages more than simply consumers. Investors' prospects of generating a profit may decrease if the housing market continues to cool, prices remain stable, and rents fall. This is why some investors may see a cooling property market as good news, since it presents a great opportunity to purchase properties at reduced prices. Many experts warn that many investors will give up on the market completely and hunt for better chances elsewhere. The recession has caused some individuals to slow down, and it now seems unlikely that they will ever earn money again. Are we on the doorstep of another insane bubble like 2008? Tell us in the comments, leave a like, and subscribe for more videos like this.